Welcome to our very first edition of Taking Stock for 2025. I hope you all had a very joyous festive season and that you're all healthy, of course, and the families are all healthy, and that 2025 ends up being another wonderful year for Aussie equity markets, full of prosperity and positivity. I'm Tim Lincoln, and joining me today is our senior equities analyst, Jason Yin, where we'll stream doing all things share market. Before we get started though, Jace, all of the information we share today with our members, of course, is as usual of a general nature and should not be construed as personal advice. And all of the data, performance metrics, etc. that we share, all historical in nature, and we shouldn't be relying that as a guide for future performance. Well, 2025 is upon us, Jace. Well done to you and the team headed by Kien in 2024, but I know you've got a lot in store for our members in 2025 also, especially as we start to head into a new reporting season. But how are you? How are your family, and how is your Christmas festive season?
Yeah, it's been pretty good, mate. I've had a pretty fantastic break and ready to really dive into what's actually shaping up to an exciting year ahead. Family-wise, we stayed put in Melbourne for the Christmas break, so it was a pretty I guess interesting and restful event, and looking forward to another year.
Yeah, fantastic, Jace. Great to hear and great to be here with you. So let's get stuck into things and let's do a bit of a reflection first up on 2024. And it was undoubtedly, as we touched on earlier, prosperous for most investors. So long as they invested wisely and adopted a lot of the philosophies that we espouse here at Stock Doctor. And who would have thought, though, that equity markets would have been so strong and performed so well,
Mm.
especially considering all of the geopolitical risks and economic risks that hung around for much of 2024 and continue to linger as we speak, perhaps to a slightly less extent than the amplification of most of 2024. And much of the strength in 2024 was really driven from the sheer weight and volume of money flowing into passive investing. And that's by way of index funds, index weighted funds, and ETFs, listed investment companies, and the like. The whole ETF is a phenomenon that we've discussed at length before, so I won't dwell on it too much here. However, with 70% of all flows that come into the global stock markets now directed into passive strategies, ETFs, weighted ETFs, so therefore the money is distributed based on index weighting of the particular equities that make up the indexes. It's becoming a real imbalance with that 70% of all flows. And we must approach this with real caution, mustn't we, Jace?
Yeah, that's right. It almost seems like there's a bit of naive asset allocation going on when you do go into these passive type of investments. And a really good example to highlight this is on the chart that we're presenting on screen right now. So if you look at the factors driving performance, you can see that the strongest factors have been momentum and also size. And these two areas are where ETFs have driven the most influence.
And despite the quality and growth factors performing modestly, as you can see on the graphic towards the bottom, really, really proud to say that our star growth stocks did exceptionally well with a return of 23% for the calendar year compared to the All Ordinaries Index, producing a very, very positive 11.4% return. Any double-digit return in a 12-month period is a really good performance, but look at that star growth stock performance at 23%, outstanding. But for the year, dividend strategies, again, as you can see by the graphic, ranking right down the bottom, struggled on the back of higher for longer interest rate environment. And this had an impact on our star income stocks, which rose around 6.8% for the calendar year, with yield of around 5%. So reasonable results. But regardless, with interest rate cuts expected to come through in 2025, there's a good chance that income factors and income style strategies should have a better year in 2025, touch wood. Jace, with the Australian corporate reporting season on our doorstep, can you believe another one has come around so quickly? Let's now turn our attention to earnings and what can our members expect from the upcoming reporting season?
Well, from the perspective of the earnings landscape, Tim, this has actually been improving over the past few months. And despite some of the pressures that we've witnessed over the consumer retail environment over the last couple of weeks, you can see on the graphic on screen, and this is trying to compare the All Ordinaries Index to the forward earnings per share trend for the Aussie market. So looking under the hood, and into some of these sectors that are driving this, we can see that the main positive earnings revisions over the last 3 months has been driven by upgrades in mining, particularly in gold. We've also seen upgrades in healthcare and also the technology sectors as well. On the other hand, Timmy, lagging the market has been lithium, which has been obviously a little bit below the weather because lithium prices have come down quite dramatically. Also, consumer staples, telcos, and the retail sector as well. And these sectors have remained under pressure, especially following a weaker than expected Christmas trading period. And this follows the announcement that we saw from Premier Investments and Maya earlier this week. So, from an investor perspective, what they should do is remain not too concentrated into some of these areas.
Yeah, very good sage advice there, Jace. And at the stock level, a great way to assess the earnings risk of a business heading into reporting season is to assess the earnings trend under Golden Rule 3 and 4. And
Mm.
to reduce the potential for negative earnings announcements, it is also useful to jump into Golden Rule 8 and see whether a company has released any trading updates through the price sensitive announcement feature. A good example of this was this week when Promaticus and PWR Holdings with their recent contract wins, which was incredibly positive. And now to Under the Microscope, Jason. Seeing it's our first taking stock for 2025, I really think it's appropriate that we revisit our core investment principles and how those philosophies can help investors prepare for the upcoming reporting season. And let's start with the big one. And why I say it's a big one, it's a philosophy that I'm going to certainly stick to going forward because I learned a big lesson by not blocking out this one for most of 2024. And that is the importance, Jace, of blocking out the macroeconomic noise.
Yeah, you mentioned that correctly, Tim. And this is a pretty critical and crucial principle to follow. But having said that, it is often challenging to distinguish between noise and sometimes meaningful signals as well. But from what we understand, the key to successful investing lies in a bottom-up approach. And this is to focus on the fundamental qualities of a business, evaluating factors like financial strength and competitive advantage and also leadership of a business as well. And that should drive a lot of the future value of these companies. Macro events, as you know, Tim, are notoriously unpredictable. So staying anchored to long-term goals and also the intrinsic values of stocks tend to yield more consistent and perhaps more rewarding results over the future.
Yeah, and Jace, just to underline the unpredictability of
Mm.
equity markets, and that's why it is critical to block out the noise because markets are so unpredictable. Just stick to that long-term focus of managing a portfolio of great quality businesses for the long term and block out the noise. But sometimes the markets don't always head in a northeast direction. That leads us into philosophy number two. And that's when markets don't head in a northeast direction, they start to experience periods of extended volatility. It's great to be able to take advantage of that volatility and embrace it as opportunity. Correct, Jace?
Yeah, absolutely, Tim. Volatility can be challenging, especially downside volatility. But like you said, it also creates opportunities as well. And during severe market corrections, investors really have two choices. One is to stay the course, or two, take advantage of the situation and perhaps buy into companies that may have been fairly or aggressively sold down. Only if these businesses remain high quality businesses and are trading at discounts. So if you have cash reserves, and this only comes from a disciplined profit taking approach, if you do have excess cash, and this gives you a bit of flexibility to act decisively and also potentially capitalize on any of these opportunities that may show up.
Excellent, Jason. Philosophy number three is the importance of diversification. And
Mm.
we don't necessarily refer to diversification from a sector specific perspective because we believe we organically identify sectors based on economic trend strength, which is great. So that's organic diversification, but it's
Mm.
more from the number of stocks in our portfolios perspective, isn't it, Jace? And with that, what's the right balance?
Well, as Buffett said, diversification is probably the only free lunch that we'll get as investors if you're looking into the markets over the long term. And from an academic perspective, a portfolio of around 15 to 25 stocks probably strikes the right balance, being not too concentrated, but also quite manageable as well. And in this way, if a few stocks do underperform, which often it does, given the nature of the market, then the impact is rather minimal over the entire portfolio. And then obviously letting some of your winners run, giving them a little bit more room to breathe, especially for long-term growth compounders like Pro Medicus, for example.
Yeah, and I love the 15 to 25 stock advice there, Jace. It really is important to avoid over concentration risk, but also members can manage a portfolio based on the full list of star stocks, whether it be star growth or star
Mm.
income stocks, quite easily achieved because it is quite a mechanical approach to that style of portfolio management if you want to match our star stock returns. And to do so, simply refer to our strategies, our entry, exit, and re-entry strategies, white paper, and video that's available in the Resource Centre. So now moving on, Jace, to philosophy number 4, and that's the
Mm.
importance of active management of one's portfolio. But is it too time consuming, Jace, or can active management of portfolio be done quite efficiently?
I think it's probably the latter, Tim. When it comes to your wealth, nobody's going to be more serious about it than yourself. So, from our perspective, we're recommending 2 hours a week is probably all you need. But having said that, it's all about consistency, Tim. I mean, it's probably like working out. If you're training, yes, sometimes the longer you do it, the more benefits you get out of it. But consistency, 10 minutes a day, 20 minutes every couple of days, set this time aside. For example, I think one of the examples that you've said is perhaps a enjoy a cuppa over a Sunday evening to review your portfolio and make any necessary adjustments. So it doesn't have to be that daunting, and active management doesn't really need to take over your life as long as you break it down into piecemeal time spaces.
Yeah, when we're talking about long-term wealth creation and the benefits of a portfolio and how it can contribute enormously to one's desired lifestyle, 2 hours a week is really nothing, is it? And so it's important, but I think that passion piece is also incredibly important also, isn't it, Jace?
Yeah.
That, and the more passionate you are, the more time you're just going to love pouring into actively managing your portfolios, which obviously would extend to a lot more than 2 hours a week if you love what you do. So
Mm.
that's fantastic, Jace. And obviously, another very important philosophy, portfolio number 6, I believe we're up to. Might be wrong. I believe it's 6. Is the importance of tailoring your portfolio and making sure it evolves relative to your net worth and stage of life. Just elaborate on that philosophy a bit more, if you could, Jace.
Yeah, this is quite important, Tim, because every investor is quite unique from the perspective of whether they're in the accumulation phase or the retirement phase. So, for example, younger investors in the growth phase often focus on capital appreciation, favoring growth-orientated stocks that might come with a bit of higher volatility. And also, they move into a preservation or income phase, then the focus typically shifts towards a more stable income generating portfolio of stocks. And the key is really aligning your portfolio with your financial goals and also your life stage. And this is to ensure that it supports your evolving needs.
And finally, Jace, the philosophy of making sure making sure you accept that at times you have to pay a premium for quality. It's a very important philosophy and rule, isn't it, Jace?
That's right. And quality often commands a premium, but most of the time it's probably well worth it. High quality companies tend to deliver superior long-term returns, and the key is to focus on robust quality metrics rather than just simply chasing discounts, Tim, because sometimes what you find in the discount bin is probably not worth the paper that it's sort of printed on. So investing in excellence often pays off over the long run.
Yeah, that's right, Jason. It's often a very good reason why a stock is cheap. You
Mm,
often get what you pay for, don't you?
that's right.
Um, the stocks in this category are often referred to as value traps also. If they are trading at a deep discount and they're poor quality, chances are they are value traps because of that declined share price. And that's why they, as I said, trade at a large discount because of their high risk of earnings pressure and also probably poor financial health. So the philosophies and the principles that just we just went through really offer a really strong roadmap and provide a lot of rigor around a disciplined and an effective investment approach. And now to question of the week, Jason. I love the fact that this question comes up twice a year. So out of our,
Mm,
how many Stock Doctor taking stock recordings do we do a year? Probably around 50 odd. I
mm,
love the fact that it comes up twice out of these 50 because it's a really strong reminder and provides us with a great framework again as to how we need to prepare for reporting season. So, Jace, the question of the week is how can Stock Doctor help our members keep track of their portfolio and also prepare for reporting season?
I think the crucial key here, Tim, is risk management. Obviously, limit or remove your exposure to financially weak businesses, and also remembering to take profits from companies that have rallied rather strongly over the last period. And this is especially when they're leading up to the results, because often you'll find that high expectations have already been priced in. Also, as well, Tim, we spoke about this a little bit earlier, have a little bit of cash on the side to prepare for any opportunities that may have been aggressively sold down during this period.
Yeah, so I suppose that is that great opportunity, Jace, to really do some housekeeping on the portfolio and get rid
Mm,
of some of those stocks that just shouldn't be there, that have been laggards, holding it back, and obviously they're the poorer quality businesses. The portfolio manager and the optimizer makes this task really easy by
mm,
allowing you to sell and rebalance your stock holdings relative to your profile and your ultimate objectives, and ensure that your portfolios are up to date and make sure your portfolio is at least those 15 stocks, as we mentioned in one of our philosophies, to manage individual stock volatility and avoid that over concentration risk. So, again, a great opportunity to apply some of those philosophies as well, leading into reporting season. Then, really, really sound and strong adherence to that active management of your portfolio is to set up alerts using the alert manager. This will and that'll also allow you to monitor any really important price sensitive announcements that are announced by companies throughout reporting season, and of
mm.
course any changes to the fundamental quality of companies as they release.
Yeah, that's right. And this is a really great tool, Tim, because it means that investors don't need to be glued to their computer screens or their phones every single day. If they set up alerts quite clearly, and the way to do that would be to navigate to the alert manager under tools. And from here, you can create a new alert. So enter the company code, and also you can select from 4 alert categories. And some of these could include star stock changes, earnings revisions, price sensitive announcements, days until ex-dividend for those income minded, and also as well, if it triggers technical indicators like the SD30 TSR, they could also be set up as well. And it just means an alert comes through, and you can then act on it if you wish.
Yep, and that's all part of that active management again, isn't it, Jace? Once your
Mm,
alerts are all set up, that 2 hours of a Sunday night with a cup of tea or whatever you choose
mm,
to do, it allows you to adjust your alerts, acknowledge alerts if they're being triggered, reset them, do all of that. That's the time that you do it during that 2 hour window, or more often again, relative to your
correct.
passion and your commitment to that active management of your portfolio. But aside from the alert manager, Jace, there's also the corporate calendar. Here you can assess report dates, like when a company's expected to report after reporting season, their annual general meeting dates, which are generally after the June reporting season, but there are some out of cycle businesses reporting their annual results through the December period. So they will be having their AGMs in the not too distant future, but not en masse like after the June reporting season. And
Mm.
if you're an income style investor, of course, you can monitor within the corporate calendar ex-dividend dates to know if you've got dividend maximizing strategies in place, then you can see when you need to be buying more of those stocks to qualify for the dividends. But just be careful here a little bit. There is an asterisk next to when there's an asterisk next to a stock code, it means that the date, any dates that we have in there, are an estimate by us. They haven't actually been conferred by the company. So just be a little bit careful there.
Yeah, it's a good point, Tim. And the estimates are usually based on when the company last reported
Mm.
last year. So we usually add 1 year to that. So companies might not confirm announcement dates until perhaps a week or so before the actual event itself. So just to make sure to be aware of that as well. But on the individual stock level, Tim, you can also access the upcoming corporate events by clicking on the date item on the top of the 9 Golden Rules page as well. And that's a pretty handy and useful tip as well if you're looking at a stock from that page.
Yeah, and another really nice feature within Stock Doctor for income style investors is the income dividend page, where there's a full history of dividend payments to allow you to get a really good feel for the sustainability of future dividends based on their past and what they've consistently delivered to investors throughout history. And when the next ex dividend date is also a bit of a tongue twister there. You can also find this information under the income section of the 9 Golden Rules screen too. In addition, you can build a list of potential opportunities that you can pick up over reporting season by using the filter tool, which is a wonderful tool to be able to go outside of our star stock list and find some of your other stocks that might be on the cusp there that you may think is suitable for inclusion in your portfolio. And create a watch list of stocks also for those that you might be keeping a bit of an eye on, waiting for things to happen post report, and certain entry in strategies as well.
And I think the filter tool is probably one of the most, I guess, prominent features within the Stock Doctor program. From here, you can really refine your searches by adding criteria like forecast ROE, if you want to set a particular threshold, positive earnings revisions, and also you want to ensure that a stock has enough liquidity. And generally, we recommend anything over 100,000 as one of the minimum thresholds, and also leveraging any price change as well. So if you're into your technical indicators, perhaps search for a bullish trend on the ST30 TSR indicator. And for the valuation focused investors, perhaps a price to consensus estimate to identify any oversold opportunities as well. But beyond these tools, Tim, there are a few tips that for managing your portfolio successfully during reporting season, and these could include monitoring short interest levels. So be cautious of anything above 5%. To also remember, avoid stocks with negative earnings revisions, like I said earlier, as this could signal trouble potentially ahead. Favor companies with a broad range of analyst coverage. Ideally, we want to look for companies with 3 or more analysts because it ensures there's greater price discovery. The last thing that you want is to perhaps invest in a company that no one looks at, which makes it rather difficult, and you'll probably have to do your own due diligence a little bit further, like what you've mentioned in your previous recommendations, Tim. Another thing as well is to look at a management's remuneration. If it's too high, ensure that it does align with shareholder returns. And speaking of leaders, you do really want to look for a leadership with enough skin in the game, and these could include founders or even passionate leaders, because you want their investment in the company to be a powerful indicator of alignment and also commitment with shareholders as well.
Yeah, great little tips there, Jace. Well done. And on the last one there, yeah, love to see the founder involved. Love to see that passion.
Mm.
Very rare, it's not always. I think, there's probably amongst our 50 odd star stocks, there's probably half a dozen stocks where that founder is still deeply involved and really driving the business hard. But when it is there, it really is quite special from especially a growth perspective. And to do that, jump on the company's website as well, not ours, on the actual company's website, and check out some videos and see the passion of the founder in there. They're sharing their genius often. If they're a star stock, they've been around for a while. and they're
Mhm.
sharing their genius of what they've created with potential shareholders and existing shareholders. So love to see that. It just increases the positivity behind the stock and fuels members and investors' confidence in putting their hard-earned money into a business that's still driven by a founder. Anyway, that's all we've got time for in our first edition for 2025. Jay, it's been great sitting down with you. I think we need to really curb our expectations this year. Been a
Mm.
wonderful year for investors. Fantastic. Oh, sorry. We need to curb our expectations for this year because last year was a sensational year. I don't think we can expect, 20+% returns for our star stocks year in, year out, even double-digit returns for the markets year in, year out. There's still a fair bit going on in the world. So let's just curb our expectations back a little bit. But if we can get that high single-digit growth in our portfolios to double-digit growth, then the power of compounding kicks in and we do incredibly well. So let's just curb that expectation a little bit. If it happens again, great, but let's not expect it. So yeah, great sitting down with you, Jace. Thanks for your time. Great to see you.
It's a pleasure as always, Tim, and thank you for sharing some of your nuggets of wisdom over this period as well. So it's been fantastic, and hopefully members would have enjoyed a little bit of that as well.
Yeah, well, it's all about the member though, isn't it, Jason? Sharing those little nuggets to hopefully allow them to become more informed and successful investors and really master the art of stock doctor that we know adds enormous value to our investment performance over the long term. So yeah, take care, everyone. I hope it's a great year for you all and stay happy, healthy, and prosperous. Thank you all very much for tuning in. We'll see you all again soon. Goodbye.